You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Quite a few programs for you guys to sink your teeth into on the old network, including hundreds of archived episodes of this here program, Volatility Views, with great guests, great discussions, all sorts of fun stuff. And we are, I know I mentioned it before, we are working on a best of show, which is going to pull segments from all of our many, many shows over the past nearly 9 years. Hard to believe. In January, it will be 9 years. So a lot of content there. I know sometimes it's overwhelming for you newcomers coming on in and trying to bite it all off at once. In addition to all the new stuff we're pushing out every day, to also go back and check out the archives. We're going to try to make it a little bit easier for you and surface some of those best of conversations, guests, discussions, debates, me mocking Mark Sebastian, all sorts of fun stuff that we've done over the past extensive history of this network. But while you're waiting for that to launch, should be sometime in the next couple of weeks, feel free to dig, of course, into the archives of this program as well as of all the other dozen programs on the old network option block, Options Bootcamp. Want to learn more about basic options trading, advisor's option, if you're into the advisor-oriented asset management side of the space, pretty much whatever floats your boat, we have something out there for you. And of course, you can find all of that at the mothership, the flagship, theoptionsinsider.com. Click on the Insider Radio Network tab. You can find it in the top left corner there of the homepage, and you're pretty much off to the races. Of course, iTunes, TuneIn, Stitcher, we're also available up there. Search for the name of the show. Just search for Options. If you want to make it easy for yourself, just subscribe to our network feed, our Options Insider Radio Network feed that has all of our programming in it, so our daily news show. Warning, it's a lot of content, but if you really want to mainline some options content, we've got it for you right there in that network feed, or you can pick and choose, maybe like Vol Views and Option Block or something else like that. Pick and choose, we won't hold it against you. Find the programs that work best for you. And joining me on this program today, the aforementioned, much maligned, greasy meatball himself, Mr. Mark Sebastian, from his many appearances on the old network, not the least of which his moonlighting gig over there at optionpit.com. Mr. Greasy Meatball, welcome back to the Options Insider Radio Network by way of Detroit this time.
Yes, beautiful Rochester Hills, Michigan. One of Detroit's, the safest suburb in the United States.
That's saying something, particularly for being in the radius of Detroit.
Well, it's not that close, but it's a great area. So, enjoying my time here. You know what I'm thinking about today, Mark?
What are you thinking about?
I'm thinking about how big of a juicy steak I'm going to eat on Jared Woodard's dime, because I am 100% right, and he is going to have to fly to Chicago and buy me a $250 steak. I'm gonna have to find one. But that will be good.
And good luck finding him. I think he has fled to parts unknown. No doubt,
Yeah,
in part,
well,
in part due
whole,
to this impending wager coming due.
Yeah, no kidding. Apparently, but that'll be a fun one to sink my teeth into.
It'll make it extra delicious. But
it will.
Yeah, you're that side of the fence. The no raise seemed like the more sensible way throughout most of the year. Jared surprisingly dogmatic in his support of the raise. He even kind of doubled down back in June, if you recall.
Oh, I know.
Which was surprisingly strident. So he hasn't had a chance to defend himself on the program in a while. Maybe we'll get him back on to defend his evolving, I should say, viewpoint.
In a vacuum, if you just look at the U.S., it makes sense. The problem is that you can't, because currency has become such an important thing for many U.S. companies, and the action of the dollar was threatening deflation in the U.S. And beyond just energy, it was hitting at all sorts of places, and energy obviously being the clearest one, but a good measure of inflation and deflation is gold, and gold got absolutely hammered. It's finally getting itself back to threatening $1,200 an ounce, but it just absolutely murdered has gold been. And I think that's a sign of really where inflation expectations are and why the Federal Reserve really is stuck between a rock and a hard place. And the Federal Reserve, the non-farm payrolls last week did the Federal Reserve a huge favor in that, they no longer had to be, wobbling, rickety, feckless Fed speak people. The market basically made the economic data basically made the decision for them. So they got to hide behind something rather than just having a set and doing the right thing, which would have been to come out and say, "Well, we were just kidding. We'll see you next March."
Here we are, about 5 minutes into the show already. We're talking about the Fed. The Fed is inescapable, listeners. But what also is inescapable on this program is the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review. You guys know the drill by now, and if you don't, you're a newcomer. Welcome to the program. This is, of course, the portion of the program where we break down what was moving, what was shaking, what was catching our eye in the week that was, and indeed still is, from a volatility perspective. We are recording this middle of the session here on Friday, October 9th, for all of you playing along at home. And it is another interesting one. We've seen a week of pretty much a prolonged rally throughout most of the week. S&P, Dow, most of the major indices rallying pretty hard. As a result, we've seen the VIX Cash, our beloved VIX Cash, coming off a bit as well. Seen a little bit of a flip of that script today, kind of a bit of a vacillating day going into the middle of the session here, with the S&P pretty much unched on the day, even though it did hit some higher levels and has since retreated off those. And of course, most of the other major indices at the moment unched, having some vacillation as well. And all this intraday vacillation giving a little bit of an inhale to vol today. We're not seeing the typical exhale going into a long weekend, which it technically isn't. Markets are open on Monday here in the States, but from a perspective of a lot of people whose offices are closed, it is indeed a holiday weekend here in the States. So typically you'd see vol taking a bit of a hit on a time like this, but nope, getting a bit of an inhale up about 0.6 of a point or so, hovering right around the 18 even level out there in the VIX Cash, which of course, Mr. Greasy Meatball, you will note, is markedly below the 20 handle out there in the VIX land. I should say, your counterpart to your better half and I The Rock Lobster had a healthy debate last week about in the crystal ball segment about where we would be looking this week from a vol perspective. I leaned more, I believe, south of 20. I believe I actually said 18, and he actually argued vehemently for the same level, if not a little bit higher, in the VIX land, which we were hovering around the low 20s at the time. And so he was feeling a little bit inflated. I was going out on a limb feeling a little bit deflated. Seems like so far deflated is winning the day. Certainly it has been deflated from at least last week's perspective for the entirety of this week. But of course, the day is not done. We may see an increased inhale to vol as the weekend goes. But in addition to the general rally in the market, the general easing of volatility throughout the marketplace, what caught your eye in this pretty much upward whole week?
Yeah, it was kind of unsurprising. Once you took one uncertainty out of the market, China's kind of calmed down a little bit. The market was due for a decent rally, and even at 22 or 23, you need 1.25%, 1.5% of movement a day to justify a VIX that high, and we're just not seeing that. In addition, I think skew got so steep that it was bound to kind of flatten up a little bit, and that's what we're seeing. So I'm not shocked at all that that's the way things kind of rallied and rolled. I think we slowed down a little bit. It might have gotten a little ahead of itself when it got to the 17 handle a little bit. But the big news is the curve back in contango. That is a big deal. A full-on contango for the first time in about, 7 weeks. So a pretty impressive run VIX Cash and futures had, at least for the next few weeks. It looks like things are going to move back toward a somewhat more normal period, although I think we would both agree that the days of the 12 VIX are behind us, at least for the next few months.
For the foreseeable future, I think we can agree on that. And you're right. I'm looking at the VIX futures term structure here. And if you just gave me this snapshot and you just stripped away what the actual months and dates were and you just kind of showed it laid out, I would just say to you, this is just an average VIX term structure screenshot. Could be from any given time in the lifespan of this product. There doesn't really indicate any severe movement. There's no backwardation to it. Doesn't show any really, really steep bids to the longer term, like there's something crazy coming down the path. It's kind of just it looks like a regular VIX term structure. So you're right. It seems like we're kind of in apparently normal mode at the moment, but you're right. A little bit inflated in the regular level. Certainly not heading back to those low teens anytime soon from a VIX Cash perspective. Speaking of VIX Cash, like I mentioned, we are south of 20. We did indeed break the streak. I believe it ended around 30 days or so for the number of days above 20. We've talked about that on some recent shows, and I believe that puts us right in the firmly in the top 20 of all time. I think we just surpassed with 29 days the February 14th, so Valentine's Day VIX inflated period of 1990, the oft-mentioned, oft-maligned Valentine's Day VIX rally of 1990, which I'm sure you're all aware of very keenly. We'll see if perhaps another flurry can drive us back into some more, another extended period of lofty volatility out there. Looking over there at the S, and you mentioned the skew index. You're right. It has come off a bit, but it's kind of getting a little bit of a bid again today. Again, of course, coming to some of the activity we're seeing today. If you follow that metric, it kind of tends to vacillate around that 125 level a little bit elevated off that right now, about hovering right around 137 or so. Again, we mentioned in the past some of the issues that skew index has, so it's not all as it appears on the surface, but it does indicate a bit of a healthy bid to those puts going forward, but nowhere near as crazy as it got recently. I think it spiked up to about 143 or so, which, if you follow skew index at all, is pretty historic levels for that index. What we're not looking at is historically high vol right now. As we said, VIX Cash coming off the 30-day implied out there in the S&P hovering right around 15.5 or so, which is decent, which is hefty, about the 73rd percentile out there, but certainly not 99, not historic levels. The 30-day actual vol out there in the S&P hovering right about 18%, which puts it a little higher, 82 percentile, but still, again, not in the record record-setting part of the curve. Looking at things, part of the curve that are catching a lot of attention this week, it's the front portion of the curve, in particular, the much discussed, much anticipated VIX Weekly Options finally joining the fray. We launched the weekly VIX Futures, a few months ago now, and there's been a lot of talk about, hey, these things aren't really doing a lot of paper. What's up with that? We've talked to a lot of different guests about why that may be. We have Typhon guys and others on here saying, well, they couldn't even get them yet because they weren't provided in their service provider, didn't have them yet, hadn't added them. So there's a lot of behind the scenes details that were going into why those weren't lighting it up the way some people had expected. And the second thing people kept saying was, hey, wait for the VIX Weekly Options to launch. Of course, you've mentioned on this show many times that there were some issues with OCC and others, perhaps with getting these things listed. They finally did it. They worked out whatever those behind the scenes details were, and we saw their first active day yesterday, and it actually was a fairly active day, Mark. Certainly, if you remember other recent notable volatility launches, not just the VIX Weekly Futures, but indeed the oft discussed, at least on this program, probably the only program on the planet that ever discussed it, VXST. This certainly looks pretty healthy by comparison, doing a few thousand contracts out there scattered across. They listed 2 contracts, one expiring in October, one expiring on the 4th of November. And combined, the two of them did pretty well, a couple thousand contracts, including a few decent-sized trades. I saw a few hundred lots going up out there in a few different trades. I have to say, Mark, my favorite trade of all the weeklies we saw so far is we saw the crazies are taking advantage of the weeklies. We saw someone coming in and loading up on 50 of the no 50 calls expiring on November 4th, paying a whopping dime for those. So we got to love it. The crazies aren't limited to February. They also come out all throughout the year, including in the newly listed VIX Weekly Options. But the kind of more esoteric paper aside, what's your take? Granted, only one day in, or about a day and a half now, but what's your take so far on these new VIX Weekly Options?
I'm looking at volume, and we have our first kind of significant trade that just went up today in those weeklies. It looks like somebody, I'm looking at what appears to be some sort of like strangle swap between, it's an 8-way between ACH and NOV. If you look, it looks like they did the ACH 28, expiring ACH 28, 19 straddle versus the 1625 strangle. And in November, they did the 18 straddle versus the 1625 strangle. So an interesting trade there. And they did it about 4,700, 4,750 a piece.
Wow, yeah, that's
so
big.
This is a, call it, the SIBO's pretty happy. That's 36,000 contracts right there.
There you go, our first whale in the VIX Weeklies.
Yes, so those that thought that this, that's some serious size. And on top of that, we already had seen between NOV and DC yesterday about, 4,000 total contracts trade yesterday. So there's been enough volume yesterday and on Wednesday. So there's been enough volume that these appear to be like they will get some legs on. They've already done more volume than VXST maybe did in its lifetime. So in that one trade. So I think these are going to catch. And with that, you should be seeing an uptick in the weekly futures as well. So the nice thing for SIBO is these build on each other. And I get it. It's hard to buy a future when, VIX is flying around. A kind of a limited risk strike contract like an option is going to make a lot more sense for a hedger than someone that's trading, like I said, weekly futures.
Yeah, this is the size print. It just went up, listeners, so we haven't had a chance to really parse it too much, but quite a few contracts here in the VIX Weeklies. Interesting trade, too, so closely tied to the front portion of that term structure. Like we said, looking at the future is not a heck of a big bid. It's not like there's anything rocking and rolling in the front portion of that term structure, which would make you think, hey, I want to spread one weekly against the other. But this is an interesting one. And again, certainly, like we said, a sizable print here in the weekly. So perhaps this is their coming out party after all, with a lot of already in this one trade, about 18 times all of yesterday's volume in these weeklies. So a very interesting print. We'll keep an eye on these, but I tend to concur, Mark, that these look like they will be around and probably doing some decent volume for a while here. Speaking of the weeklies, we talked a while back, Mark, over a month ago now, because it was August 24th. The date is burned in our brain. That is indeed the big sell-off day in the old market. And, of course, a lot of conversation came out of that, including a conversation about why the VIX itself stopped disseminating for about a half an hour. That really threw a wrench into the works for a lot of people out there. It also set the conspiracy theorists on fire as to what was actually going on out there in the market that day. And it certainly added to the general note of panic and confusion in the marketplace because everything's down, everything's crashing. This widely disseminated gauge is no longer being disseminated. It seemed like a confluence of events were really hitting the market that day. And we talked here on this program, others mentioned as well, kind of the widely disseminated theory about that was that simply, the market makers were getting just too wide. It was too hard. Things were too illiquid at that moment to really disseminate and calculate the index. And it seemed you and I are both market makers. That's a fairly rational theory. We've been in those environments before where no one really wants to quote. So it certainly made a lot of sense. But to the folks over there at Barclays, in particular, Manish Deshpande, he's been at the RMC event, and he's also, I've talked to him many times in the past, a pretty level-headed guy, not known for his rabid pronunciations or proclamations about the options and volatility market. That didn't make a lot of sense to him. It didn't ring true to him, particularly because he's looked at it in the data, and he said, VIX and SPX, have sold off aggressively before, and yet we didn't see any issues with VIX being disseminated, so he thought something else may have been at work there. So he started digging through. He said, what's different about VIX now than when it was the last time these massive fluctuations hit the market? And lo and behold, he settled upon the weeklies as well. Remember, we talked about it recently on the show, listeners. The calculation has been changed a little bit to incorporate the weeklies going forward, and we kind of speculated about how that may impact the index, maybe adding a little bit more volatility to it, make it move a little bit more, as the weeklies are much more of a gamma-prone instrument. They tend to have a little bit of movement to them. And so no one ever thought that they might perhaps be responsible for something like this. Yet according to Manish's research here, that it was the weeklies that actually were the crux of the issue, because at the time when everything was selling off, people were focusing their quoting on the big options. They kind of abandoned the weeklies out in the S, and as a result, those were not liquid enough, those were not disseminated enough to allow them to actually calculate the new methodology of the VIX. Hence, they were to blame for the shutdown as opposed to the general blame on the market makers not disseminating enough quotes there. Kind of an interesting bit of nuance, kind of interesting wrinkle into the way the VIX is calculated, and perhaps opening it up to some future issues. Have you had a chance to review this, Mark, and what's your take on perhaps the weeklies and the weekly calculation being to blame for the VIX shutting down for that day?
I mean, that makes sense. That makes a lot of sense to me, because those are fully electronic. They're not hybrid. So, that would make a lot of sense, and maybe makes a case that even the weekly should be on the hybrid system, not just over the electronic. And, so maybe there's a strong point there.
Yeah, that was one of the things people brought up about yesterday's session. We haven't had a chance to dig into this size print here on today's weekly. So maybe that went up maybe that went up open outcry. I don't know, but I know all of yesterday's volume was completely electronic in the weekly VIX options. So there was no open outcry, and if they could put up 36,000 contracts electronically with no issues, who knows? But perhaps that is indeed an argument. You're right, for getting a little bit more exposure to the pit and indeed the hybrid system rather than just keeping it electronic. Either way, an interesting discussion point, I know, for all of you out there who are still putting out these various theories as to what was actually going on back on August 24th and what caused the sell-off. Perhaps an interesting new wrinkle as to why the VIX didn't play ball that day. And before we move on from the big sell-off on August 24th. I'm not sure if you saw this, but it caused a lot of waves, certainly in the world of volatility and indeed the market this week, Mark. But BlackRock, of course, pretty much the biggest asset manager out there, they disseminate a lot of the products many of you may trade, including a lot of the ETFs and other structured type products out there. Well, if you followed along with what happened on the 24th, you know, that was a pretty bad day, particularly for a lot of these ETF type products, because as you know, they are structured from some sort of basket of other components in the marketplace. And when all of these components are moving willy-nilly and dropping and gapping, it makes it kind of hard to disseminate an actual value for the ETF itself. Take the VIX problems and multiply it by many, many different underlyings, and you could see the issue that they were having. And of course, they got a lot of heat for that. A lot of the ETFs were really, really put under the microscope after August 24th, saying, hey, look at these financial ETFs, for example. Most of these components, none of them dropped more than 10 or 12%, and yet the ETF gave up 30%. You know, a lot of issues with the mechanics and how these things performed. So it's not surprising to see a big money manager like BlackRock trying to take some steps to help improve that. They're also couching this mark, which I thought was interesting, under the terminology of trying to improve market volatility. And they've come out with a couple of pretty broad and sweeping fixes. A lot of them kind of improvements to existing systems we already have. For example, they want to improve the limit up, limit down, make it more uniform across all exchanges and all venues, stocks, options, derivatives, etc., to kind of make it more uniform for different thresholds for when the stocks halt, etc. Also, they want to have uniform, what they call uniform price bands for different securities. This is one that really hits home for them because a lot of different issues really moved and were halted at different levels and different percentage movements on that day. And that, of course, if you're trying to compile an ETF off those issues, is extremely problematic. And they have some interesting nuances there. And again, all this kind of goes back, is couched under the terminology of trying to improve market volatility, and certainly it might indeed have that effect. But also, Mark, you can certainly see they have a dog in this fight when it comes to actually calculating ETFs. So I'm curious what your thoughts are on these BlackRock kind of sweeping proposals to quote unquote fix the market, fix volatility, but also as a side effect make it easier for them to calculate their ETFs.
Oh yeah, you know, of course they're going to be able to fix volatility and all that. Super easy. No way I'm sure it'll go super smooth. I'm not a believer. Let's just put it that way.
It sounds like you're a little bit skeptical here.
I'm quite a bit skeptical that it will have any marketable difference on any of this.
Yeah, if you look at the data coming out of that August 24th, over 1,000 issues were halted, including stocks and derivatives. But if you look at the makeup of the names that were halted, most of the lion's share of those were actually ETFs, because they simply couldn't function in that environment. So if you're one of the world's largest producers and disseminators of ETFs, well, what are you going to do? You're going to try to find some solution to it. This is an interesting one. It'll be interesting to see. They have some muscle, obviously, to get this done. When they knock on the exchange's door, the exchanges tend to listen, as do the regulators. So it'll be interesting to see if they adopt these. I think some uniform structure that applies across venues and exchanges certainly is a good way to go about that. We've seen some good developments coming out of the wake of, let's say, things in the obvious error rule and the options market, making it a little bit easier to kind of fix some of the errors that go on there. Maybe a systemic approach to this across on a market structure perspective can have a similar benefit to the marketplace. We'll see how this plays out, but obviously they have a bit of an axe to grind in this as well. But still interesting. If anyone can get it done, it is indeed the folks over there at BlackRock. So we'll see how that plays out. We touched on weekly VIX options before, and indeed doing quite a bit of volume this week. There were, of course, trades in the big VIX mothership options as well. It seemed like there were kind of a couple of different narratives to the week. Earlier in the week, as we were in rally ho mode, it seemed like people were trying to perhaps dump some of that upside protection they had out there in VIX land. We saw some early waves of call selling, but as the week went on, it seems like the narrative kind of shifted back into just kind of buying that upside protection again. We saw a lot of interesting stuff, a lot of some weird stuff too. Saw some stupids going up, Mark. Don't see those very often. Saw the no 42-47 call stupid going up on a ratio. I think it was 3 by 9,000. So some weird prints out there, and also just your standard size call buys out there in VIX land. 45,000 of the AUK 22s going up a couple of sessions ago. So a lot of still the narrative still the same out there in terms of gobbling up a lot of upside. Did see some put trading as well. In fact, we'll get to that in a minute when we get to the top 10 active strikes out there, the hot strikes that puts kind of dominating the top 10 this week, which is a bit of a surprise. Looking at overall volume out there and open interest, things are looking pretty solid out there in VIX options land, hovering right around the 90th percentile out there in terms of open interest. So things are, even though these last few weeks net haven't been the busiest from an overall volume perspective, they're lagging behind their ADV in a lot of these days out there. Still, things are overall looking pretty strong from a volume perspective. Looking where people are actually trading out there, the big strikes out there. Number one, still the OC30s, once again, with about 250,000 contracts open. That one really hasn't changed too substantially. And about 250,000 too for the OC22s, as well as the Jan 30s, all coming in right around that 250,000 level for the top three, then about 227,000 for the NOV 30 calls. Then we get some puts, the OC20 puts, the number 5 spot with 214,000 contracts open. Of course, the OC35 calls, 189,000, number 6. Then some more puts, the OC18 puts for about 184,000 contracts open, and then number 8 and 9, the NOV 20s and 25s with about 182,000 or so each. And then number 10, yet another put, the OC15 put, the OC14 put for about 176,000 contracts open. So it's been a while, Mark, since we've seen a lot of really heavy put activity out there in good old VIX land. And of course, we had a pronounced decline in the index this week. That could, of course, played into the put love. Aside from all this and just the craziness we saw in the VIX weekly options this week, Mark, anything else catch your eye out there in VIX options land? Any sizable trades? Any interesting developments that really caught your eye this week?
Nothing really crazy. The trading was pretty slow this week. Like I said, I think the highlight has been the VIX weeklies, and those are just starting to heat up. So that's kind of the way I see things.
Yeah, VIX weeklies, if they can keep doing volume like this, then we may have to have a separate chart pretty soon, or actually not even a separate chart. They could be included in the top 10 pretty soon. We keep seeing some 36,000 contract trades like this, and they could be doing all right. But maybe it is worth, we'll have to investigate that for future shows, whether it's worth breaking down that volume perhaps separately, because it is interesting stuff out there. We'll keep an eye on that. Certainly only about a day and a half in so far, so a lot could really play out in the coming weeks out there in the weekly side of the fence. Turning our attention, you mentioned it earlier, Mark, to the shiny stuff and what's been rocking and rolling out there. Gold's been an interesting one to watch. Rally ho again today out there in gold land, but in general, it hasn't been, shall we say, the best of times to really be owning yourself some gold the last few sessions. Notwithstanding, it has been rocking and rolling. We mentioned before, if you haven't done it, listeners, go check out our episode, Long and Short of Futures Options. We had a deep dive into gold options and indeed the implied volatility out there, or indeed lack thereof. It was very well timed and certainly still applicable to what's cooking out there in gold land. Mark, you mentioned gold at the top of the show. I know your preferred vehicle for trading gold is GLD. So what caught your eye out there from a gold vol perspective this week?
Vol's too cheap in both gold and in bonds. They've been moving around and nobody's buying the premium. So, on Track the Trade, which is my SIBO TV show, I did a November butterfly that is performing well. And as I look, I think, if you look at bond vol, bonds are moving and this stuff is just cheap, trading well below its 10 and 20-day historical vol. And it's not like long-term stuff hasn't been moving around. I don't exactly understand why they don't want to bid this stuff up. Generally speaking, when things move, I like to buy premium, but they don't seem to feel the same way, and they don't seem to feel the same way.
Yeah, I'm looking at the numbers here, in particular for GLD, and 30-day implied vol out there hovering at about a 15.5 or so, which is just slightly south of the 50th percentile out there. So yeah, a little bit on the cheap side out there from a 30-day implied. Looking at the actual vol, 30-day is about 15% again. So again, that would put it in about the 60th percentile out there. So right almost in line with what it's been exhibiting over the past 30 days. 60-day actually a little bit lighter. Of course, that takes into account kind of the earlier period I mentioned where right before the vol really started to kick in. That's about a 14.2% out there, which puts it smack dab at the 50th percentile. If you go all the way back out there, 120 days, then you're talking about 13% volatility out there, which is historically very low, about the 26th percentile out there. So depending on your frame of reference, gold vol is actually cheap or extremely cheap, which is interesting stuff. Looking at the big futures options out there and the skew that is lining up out there in the big gold futures options, it kind of is a bit of a pick'em at the moment out there. This one has kind of vacillated a lot, kind of like crude, as we've mentioned before as well. We've seen heavy biases jumping into the skew at various moments when people are, the bulls are in play, the bears are in play, people favoring the puts, people favoring the calls. And certainly there's a sharp steepness in the near term portion of the curve where people are just bidding up everything. That seems to essentially be the narrative pretty much across the lion's share of the expiration months all the way out to December of next year. No matter which month you're looking at, it's pretty much back to that old smile shape for the most part that you've seen sometimes in these periods where people are not really certain where gold's heading, but they know it's going to be moving somewhere sometime soon. So maybe you're right, Mark. Maybe this is an interesting moment to be picking up some gold vol on the combination of it looking pretty cheap from an historical perspective, as well as the options at least pointing to the fact that people are looking for it to move somewhere. Perhaps this is an interesting time to be loading up on some gold vol here. Looking at, like I said, looking at this skew, people are expecting it to go somewhere, but perhaps not sit here in the near term. An interesting recipe for perhaps buying some premium out there.
They're giving you the straddle and bidding the wings. That's like my favorite trade. I'll sell you the wings all day if you want to give me the straddle. Done. Give it to me.
Yeah, that's exactly what they're doing. If you look here at the skew and listen, it's kind of hard to do on an audio podcast. Obviously, we can include it in the notes, though, for you. You can see that's exactly what they're doing. They're bidding the wings up to high heaven and kind of giving you the guts, the meat at a bit of a discount, which, as Mark said, is an interesting opportunity for those of you out there who may think this thing could indeed be rocking and rolling. Speaking of rocking and rolling, we got crude as well, but we also have a listener question about that. So I think I'm going to cheat and combine the two and just dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. This is indeed the portion of the program where you guys get to join Mark and I and our guests and the entire Volatility Views panel here with your questions, your comments, your insights, not just for us, but for your fellow listeners out there. And I mentioned we have a question about crude, so I thought we'd kick things off there. This question comes from Nigel B. He writes, hey, how are crude options and volatility looking with this rally toward 50? Lots of call love. Well, of course, this came in last week when the rally to 50 was really in full gear. And we have seen, looking at it now, vol is indeed still a little bit slightly coming off out there. Is hovering around about a 44 or about a 43 to 44 in OVX and OIV. Of course, we know they've recently gapped up into the 60s at some point. So these are certainly on the lower end of the recent spectrum. Looking at what we're seeing from, again, a vol skew perspective across the wide variety. I happen to pull up WTI. I'd imagine the paper is similar in Brent, but I haven't pulled that up yet to check for you. So we'll keep it restricted to WTI for the moment here. But in general, we're looking at, it's not the same story as we're seeing out there in gold, which is gold's kind of a market bid to the wings like we mentioned, pretty much people expecting things to rock and roll, and certainly heavy bid to both wings when you're looking at the nearer portions of the curve, as you might expect right now, because the product has been moving quite a bit. But in general, when you get to a little bit farther out there and certainly into next year, what we're seeing is essentially a pronounced bid to the downside, and some love to the calls, but mostly it seems like the action, the love, the premium is out there in the put wing, which would show that perhaps a lot of people are fading this rally, or perhaps concerned that this 50 level is unsustainable. That would also echo what we've seen come out some of the big banks like Goldman of late, which have been talking crude down quite a bit, saying, yeah, well, they talked it down to the extreme, saying it could go down as low as 20. This paper doesn't show that level of concern, but still, people are concerned, which is interesting given the fact that, we have rallied recently, but crude's still hovering at certainly near 1-year lows, and yet people still piling in the preponderance of paper. Say that 5 times fast, Mark. Leaning to the downside. A, does that surprise you, Mark? And B, what else is catching your eye out there from a crude perspective? It could be out there in the big futures options here like WTI, or I know you like USO as well. What's catching your eye out there from a vol and indeed from a trading perspective?
I've been impressed that the vol's been this firm, and it certainly is. They've been bidding this stuff up for a while, and that's because there's still lots of hedging going on, tons of hedging going on across all these different there's all these different drillers. They need the hedge. So I think that the dramatic move that we saw in crude is causing some residual pain, but we might have just experienced, kind of in terms of lows, a March 2009 type of thing where we threatened the lows, but volatility didn't threaten the highs. And we may, especially with the dollar now softening, we could see vol premiums expand aggressively, or we could see vol premiums come in and WTI make a move a little bit higher over the next period of time. I'm not a bear in oil at this point. And my guess is Goldman was buying as much as they could when they were saying that it was time to dump. Those guys aren't wrong very often.
Well, for their
Although
sake,
their trading desk and research desk have a Chinese wall.
For their sake, let's hope so, because if they follow their own recommendation, it hasn't really worked out too well. Yeah,
they would be losing money hand over fist as opposed to just constantly printing cash.
But you're right in terms of the vol out there. I mentioned it has come off, over the last, since the last big spike. But in general, one of the less interesting stories, certainly over the past few episodes of this show, has kind of been crude vol in terms of any real change. It's been kind of locked in that low 40s range, whether you're looking at OIV, OVX, I don't care what your measure is. It's kind of been locked there for the better part of the last few weeks. And you're right, it hasn't really eroded much below that level, even though net it has come off from the mid to high 50s or so, where it was vacillating around for a while. But the last few weeks kind of been in this, 42 to 44 or so range and kind of bouncing around there. I think it got as high one day back in about hit 48 very briefly in the big movements there a couple of days ago. On the 7th, we saw a bit of a blip there in crude. But other than that, it's been kind of pretty much range bound. So long answer to your question there, Mr. Nigel B. It doesn't seem like it's the same thing as gold. It actually seems like the interest, the concern, the premium on the put side. So if you're if you're a bull, then maybe perhaps there is an opportunity here for you to pick up some upside at less of a premium than you would out there in gold. So that concerns you. Or of course, the downside is you don't get to sell the wings if you want to maybe buy a vertical for as much juice as you could in gold. So there's a bit of a plus and a minus to it there, depending on how you look at it. Moving on, let's see, we got a lot of mail. Let's see how many we can hit this week. This next one comes from Alamut01. He or she writes, hey, SPX sells off over 2%. This one actually comes in obviously from a couple of weeks ago because I didn't have a chance to get to all of them on every show, listeners. SPX sells off over 2% last week, and the VIX barely budges. What up? He writes. This is kind of a constant refrain. We've seen a lot, Mark, in the listener mail, certainly since the big sell-off on August 24th. People have been writing in a lot of different questions and comments about what's going on out there, how this thing actually performs. We get a lot of these types of questions in general. Hey, the market rallied. Why did the VIX rally? You could ask that question again today. In fact, I'm sure we'll get some in the inbox today. Probably have some waiting for us right now. A day when the market was kind of slightly up and also VIX Cash also up. Those days tend to confuse people. That said, Mr. Sebastian, what do you have to say for our friend here, Mr. Alamut01, who wants to know how SPX could sell off over 2% and the VIX barely budge? If you recall that session, Mark, I think we even talked about it on the show. That was one of the big sell-off days, and the VIX was up. It was only up a few handles, I believe, at that day. So that's kind of what he's referring to.
Well, you got to remember the VIX is forward-looking, trying to be forward-looking, even though it is somewhat reactionary. And once the reason why the VIX moved so hard in August is because the market didn't see that coming. Once the VIX is at 25, then it's pricing in a 1.5 of movement a day. A 2% move would be about a 32 VIX, but you'd need that every day, and that's unlikely. So the VIX was basically saying, yeah, you know what, today was kind of cruddy, but I don't think the movement's going to be like this every day. And so you have to understand that it's not just how much the market is moving, it's how much the market is expecting movement to continue. And there was not that kind of thing. So
I'm looking here. I believe the day he's referring to was September 28th. That's when we saw the VIX, the SPX sell off pretty aggressively. And the VIX was up, VIX Cash up about 3.5 handles at its peak. And then it kind of gave off most of that throughout the day. And I think what you said right there pretty much nails it, Mark. And people have to remember, especially at that time, on that particular day when he wrote in, I think the VIX opened at a 25. So that's when we were talking about where we were right at the height of that really backward portion of the curve. The front portion of the curve had just been bid up astronomically. So you're, like you said, you're already pricing in a pretty aggressive move. You can't expect the VIX to double just because the SPX is selling off. You're already pricing in a fairly substantial move, which again, you have to remember, that's why we always say volatility has a context. There certainly was a context that day. We were in the midst of this very high volatile environment. The VIX was already backward. It was already pricing in a lot of movement. So you're kind of getting the movements already priced in, plus a little more. So that's kind of why you saw it reflected that day. If that was just a regular day, probably, and who knows, back where we were a couple months ago when things were relatively quiet and VIX Cash was vacillating between the 11 and 14 handle, and that day happened, yeah, we'd see a pretty aggressive move because that wasn't priced in to the product at that point. But at that point, when VIX Cash is already hovering around 25, a lot of that's already baked in. Speaking of products, we've got a question here from IVUP. I like that. He writes, hey, can you please give us a status update on the Voldex products, particularly a release date? If you guys recall, we had the folks from Voldex on the show. It's over a year ago now, I believe. I'll have to look up the exact date, perhaps, as we continue with the program. I can find it for you in the exact episode. But in general, actually, it was episode 131. Look at that, a little bit of Google foo, listeners, from October 13th of 2014. So pretty much almost exactly a year ago we had them on. And you remember at the time they kind of talked about what this product is. If you're not familiar with the listeners, it's essentially kind of like going back to the old version of VIX. It was before they iterated the calculation, not to calculate the weeklies, but indeed the iteration they did about a decade ago where they added the skew. Some people, for whatever reason, not a fan of that, so Voldex trying to cater to them by essentially taking that skew out of it again and trying just to deliver to you the at-the-money vol portion that the VIX was initially intended to deliver out there in the SPX. I did, because we got a few questions like this recently, I did reach out to the folks at ISE. They're the ones who are partnering with Voldex on this product to say, hey, is there anything I could share with you guys, any updates, any time frame, anything you can give us? And the answer was unfortunately still a resounding no. They don't really have much in the way of an update. From my familiarity with this product, the big sticking point, as it is with a lot of the new vol products coming out there right now, is they need an underlying to really base the product around, and that's kind of where they're getting held up. You can list the options all day, but as we've seen before here in the market, if you don't have an underlying to go with it, they tend to go together, and if you don't have one, you're missing a good part of the equation. And so these guys are kind of hung up on whether they're going to list an ETF or a future, what shape that's going to be, and if you list a new product in the space, if you're going to launch a future, you have to partner with some sort of futures entity, et cetera, et cetera. There's a lot of behind the scenes, machinations that go into that. But long story short, unfortunately, I don't have any update for you. You know, we here on the show, we just love to see more opportunities for you guys to trade vol. We don't care what it is. So we like to see more products entering the game, and yet, unfortunately, not enough to really update on this one. Mark, as I recall, you were kind of like you kind of were questioning the need for a skewless version of VIX, but is that still your case? You still not really a big fan of this one?
No, I mean, skew is an important part of option trading. And a real driver of how professionals trade. I think it's kind of silly to try and pull it out, to be honest. And so, my general feeling is that, I don't, if people didn't want skew, VXO would have stuck around, but they do. So I just don't see it.
That to me was always the big addition that they made to the quote-unquote new version of VIX. They added the skew because at-the-money vol, the at-the-money straddle run doesn't tell you the entire vol picture, not by a long shot. Look at all the skew talk we had on the show today. So having a product that attempts to give you that vol snapshot and not incorporating some of the wings really doesn't tell you the whole picture. Now, some people will argue that has opened it up to some of the things we've seen, like the carpet bombing around expiration and stuff, and that certainly is a valid point, but I still think that is a viable part of the picture, and it's informative, and you should include it in the product. But again, I'm not everybody out there, so if you're interested in a skewless version of VIX, hopefully this one will be hitting the market sometime soon for you guys to sink your teeth into. And hopefully at least we'll have some sort of update we can give you. Maybe we can bring them back on again when that time is right for them to talk about exactly, when this product's going to hit the market. Let's see, we got time for, a couple more here, I think, maybe, at least one more. This one comes from Agave. He or she writes, "Hey, is it true that volatility skew was born out of the 1987 crash and didn't exist previously? I heard that recently, and it seems difficult to believe." Yes, that is indeed true there, Mr. or Mrs. Agave. If you look back at, and of course the 87 crash predates both Mark and I's time in the option pits, but I spent a lot of time in and around people when I first got on the floor who were there in the 87 crash and looking at the models they had and how these things broke down, or I should say lack thereof. There really weren't that many models running back then. So you remember the computer hardware a little bit less than it is now as well. Skew is very much an observed phenomenon. It came out of that event and kind of the subsequent vacillations in the marketplace. People looking at these who are a little bit more sophisticated and saying, you know what? The way we've been pricing these all this time and kind of just expecting them to do this, they kind of did that. They did Y instead of X. And why is that? And starting to investigate why that is. And that became the phenomenon that is very widely known and modeled now called skew. And so that was kind of the genesis of it, at least in terms of its really popular adoption. There may have been a few people maybe experimenting with that idea before then. I don't know their exact time frame, but when it became widely embraced and adopted in the marketplace as an actual component of the market, that was pretty much when it is. And that's kind of why we hit on a lot on this show, the real differences between just pure academic finance and actual practical application, because when it hits the market, it's a completely different beast. And, skew is one of the best examples of an observed practical phenomenon that if you had just looked at options in the theoretical vacuum, never would have thought existed, and yet clearly does, and clearly is an important part of the marketplace. Mark, anything to add here for our friend, Mr. or Mrs. Agave, who wants to know about the origins of skew?
Well, if you talk to, I had a long conversation with Shelley Natenberg about this, and he's pretty insistent that there was at least some at the real far out areas, there was some type of smile and skew in the really, really cheap stuff. And that kind of going into that, by the crash 87, some of the smarter groups had started to figure out that supply and demand were moving things around a little bit. So it did become widely adopted after the 87, but it wasn't invented by 87. There were smart people that were taking advantage of skew and supply and demand forces for a very long time prior to that. And the far, far cheap stuff did still have that weird thing where the model broke down and it did not decay the same way, because guys had, even before there was skew, there was still the margin tie up, and guys didn't want to be short a teeny when it was going to for weeks when the SEC was going to charge you the minimum haircut rule. So there still was, at the outskirts of the curve, little pieces of skew. And by the mid 80s, there were some smart people that were looking at it. But it became widely adopted after 1987. I think is the better way to think about it. Think about it this way. By 1450 AD, most really smart people believed that the Earth was round. It was after Columbus ran into the what is now, I believe it was the Bahamas or Cuba or something like that, that it became widely accepted, and I think skew's kind of the same way.
Yeah, that's kind of why I use that caveat there, that widely adopted, because you're right. I have heard people talking about how they were researching certain elements of different things prior to 1987 that wound up becoming what we know of as skew today. They didn't call it that back then. And you're right, there were some observed phenomenons in the marketplace, like margin, that did have a similar effect. So it wasn't entirely novel. But yeah, when you talk about widespread adoption, when everyone kind of smacked their head and said, oh, wait a minute, a wake-up moment, that's clearly when it was. Great questions, everybody. You guys really bring your A game. I love it. We should probably do a whole question show one of these days. But for now, we got to keep on rolling. Right on into our final segment. It's time for the ever controversial crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, Mark, we're down to the nitty-gritty now. This is the more controversial, perhaps more difficult part of the show, certainly over the last month or so, when everything's been rocking and rolling. Like I mentioned on our last episode, Andrew and I coming down at two very clearly distinct visions for what the market had in store for us from a vol perspective. Now we are hovering right now at the lower end of that range, almost exactly at 18. And of course, we are in a little bit of different dynamic now. We're not as, at least some of us are not as Fed obsessed. It seems like there aren't any shoes coming out of China to drop, at least for the next couple of weeks. So we can focus a little bit more on the actual market, the actual domestic drivers of this market, like earnings. Earnings season kicked off this week. So hopefully, let's say hopefully, that's still a big question mark, but hopefully that will remain the key driver for us going forward, at least until the next time we can gather here together on this program. So all that being said, Mark, I'm gonna hover around the same level again. I said we're gonna come off last week and get into about the 18 range. I could easily see us being right around this level again next week. That said, China does something crazy. Miss Yellen raises her finger, or some of these earnings get kind of crazy. Back into the 20s wouldn't surprise me, but I think we'll be hovering right around here. Which way do you hover? You think we'll be here? You think we'll be spiking back up? Think we'll be back down, not 12, maybe 14 or 15? Where are you feeling for next week?
I mean, I actually think that we're going to be plus or minus a point from here, to be honest. I don't see how a lot of things to move us for, much. I don't think we're gonna have much time above 20, and I don't think we're gonna drop anywhere below 16.5. So I would sell the 18 straddle, or the 18-19 strangle.
There you go. Putting his money where his mouth is. He did it 7,000 times as we were speaking, listeners. So
size up.
Size up. Keep an eye on that one. But a rare moment of unanimity here on the crystal ball. Hopefully it won't stay that way for long. Hopefully we'll be bickering and arguing again very, very soon as to the future of volatility. As for the future of this program, unfortunately, there isn't one, because this episode is done. There'll be more episodes, of course, but this one coming to a close. But before we go, as always, let me check back in with my cohort here, my partner in all things volatility, the Greasy Meatball. Mr. Greasy Meatball, what's cooking in your neck of the woods that may interest our volatility crew here?
I've got a webinar next Thursday. It's on volatility and earnings. So it's going to be about how to evaluate volatility and how to evaluate volatility around earnings and what earnings straddles are telling us. The link is going to be in the show notes. Or look for an email from me today and or Monday inviting you to the webinar.
There you go, listeners. Keep an eye out for that one. And great stuff, great questions this week, too. And I think maybe we should do a show one of these days on kind of getting into some of the early primordial mists of things like skew. I think that'd be kind of fascinating. So maybe we should devote more time to that in just about 5 minutes on the mail block, but still, the volatility voicemail. But that's for another episode. On behalf of the Greasy Meatball and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. And of course, for sending in such great and varied questions. Keep them coming. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.